When new investors get started in the stock market, many times they are disappointed when their purchase value drops. Not understanding why or what happened, oftentimes the investor makes rash decisions where even more money could be lost. It's common to experience this in your investing adventures. I know I certainly did. But looking back at my mistakes and researching others, there are a few other reasons why most people lose money in the stock market. There, of course, is no guarantee of your success or what percentage of returns you'll have. But if you are investing for the long term, the below information will be beneficial to your pockets and financial future. You might have heard the random investing stat before: 90% of people lose money in the stock market. To me, that really refers to people day trading without real knowledge, not long-term investing for the future. Regardless of how accurate that is or not, many people do make costly mistakes when it comes to investing in the stock market. Many of the reasons may be obvious, but they are also easy to overlook or forget, especially if you are new to the investing game. And even if you do adjust your approach and mindset, it's expected that there will be occasional losses due to the economy or market shifts. That all said, let's dive into some of the reasons people lose money in the stock market. Reason number 1, it works. While some businesses rise and some businesses fall, all businesses in the country, as a whole, make money. If you look out your window, there are clearly more houses, more roads, more business, and more buildings now than there were 25 years ago. That's because while individual humans may get rich or go broke, humanity as a whole marches forward. This, however, does not mean that if you just plunk money into the S&P 500, it will go straight up. As we've seen, the index does have negative years. However, when held over sufficiently long periods of time, i.e. 15 years or longer, it is impossible to lose money. In fact, the median annualized performance of the S&P 500 over 15 years is 12.2%. I'll take that kind of performance any day. Reason number 2, it's simple. The finance world is rife with people selling complicated schemes, using options or collateralized debt or whatever in an effort to confuse you and rip you off. But making money in the stock market is not complicated. In fact, the more complicated the product, the more likely it's terrible. But index investing is simply based on the fact that businesses make money as a whole and will continue to make money as a whole. That's a concept that an 8-year-old can understand, and that's why it works. Reason number 3, it's cheap. Active trading is expensive. Every transaction costs money, you have to pay the guy managing it, and you have to pay for fancy ads and office space. Besides, all that cocaine and hookers Wall Street goes through, that stuff ain't free, because there's no fund manager who has to pick stocks behind the scenes. Index funds and index ETFs have ridiculously low fees. The average management expense ratio, or MER, of an actively traded equity mutual fund is north of 2%. An index ETF that tracks the S&P 500? 0.1%. Reason number 4, it's impossible to go bust. The number one fear of everyone that invests is losing all their money. And if you pick individual stocks, it is absolutely possible to lose your shirt if all your picks go bankrupt. However, because index investing buys the entire market, the only way for it to go zero is if all businesses cease to exist. And if that happens, the aliens have already invaded and blown us all to smithereens. So who cares what your portfolio looks like? Reason number 5, the banks don't want you to do this. Which brings us to the final and most convincing reason to use index investing. Here's an exercise. Walk into any bank. Ask to speak to an investment advisor and tell them you want to put all your money in low-cost index funds. Now watch with amusement as they try every salesman-y trick in the book to try to talk you out of it. Why are they doing this? Because the banks don't make any money from index funds. They can't churn your accounts. They can't lock your investment in for an arbitrary amount of time. They can't even justify hiring an expensive money guy to run it. Instead, they want to put you into shitty, actively managed mutual funds that charge over 2% for lagging the market, and then collect their fat commissions for doing a crappy job. In fact, I've heard some Wall Street people grumble about those damn indexers. Why? Because those analysts and traders spend all day trying to price and reprice individual stocks, which causes the index to rise and fall. And over time, if they do their job correctly, the index will rise because the index is getting repriced to reflect the fact that businesses make money and are therefore worth more. So from their perspective, they see index investors as stealing their hard work, benefiting from all the time and effort that goes into analyzing every company on the stock market while not paying them a single cent. So basically, every time you buy an index fund, you are stealing from Wall Street. And if that's not a good reason to invest using index funds, then I don't know what is. What was the biggest return you've made in the stock market so far? Let us know in the comments below. Thank you for watching. Don't forget to leave a like and subscribe if you're new here. And until next time, keep up the hustle.